Welcome to the Amberdata podcast. I'm Chris Martin, analytics lead at Amberdata, joined today with David Duong, CFA from Coinbase's institutional team. David, welcome to the podcast. We have a lot to talk about today on DeFi, the current state of the crypto markets. Can you tell us a bit about yourself and what you're currently working on?
Yeah, thanks, Chris. Thanks for having me on here as well. I am the head of research at Coinbase Institutional, and that's separate as an entity from the Coinbase platform that many people know, which is the retail side of things. Coinbase Institutional, we mainly deal, as the name kind of suggests, with just institutional clients. So that would be like traditional hedge funds, corporates, real money funds. And what I do is I provide market intelligence to those clients. That would come in the form of, hey, what's going on in the macro world and how is that influencing prices at the moment, or what are the tokenomics behind a certain project and how is that kind of impacting things, or just in general, like what are the developments that are going on in the space right now, either on the regulatory side or something. And, what do you need to know today in order to effectively be able to trade the space?
Really exciting. You have a background as a CFA. Can you tell us how you got into crypto?
Yeah, so my background is actually in emerging markets. So for about 17 years, I was in traditional sell-side banking. And pretty much the entire time, I was in emerging markets, rates, and FX. So I knew currencies really well. And, not just currencies, but emerging market currencies, which is a whole other animal, as many people in the traditional finance world will tell you. And that's important because it gives you a lot of perspective about, how something like cryptocurrencies actually fit in to, the ecosystem as a whole, the financial ecosystem, because I think you kind of lose some of that flavor when you work just in developed markets, because you don't really understand the use case behind a lot of these kind of protocols, blockchain technology, or something like Bitcoin, if all you are just following US markets, for example, or European markets, because you don't see what happens when, say, like there are capital controls in a country and you can't kind of get your assets out. Like we saw what happened a few months ago with the Bank of England, for example, when they intervened in the currency and everyone was panicking and saying, like, this is extraordinary, this never happens. In emerging markets, it happens all the time. And you kind of see that use case for cryptocurrencies. And I think that's kind of what drew me to it. I also, have to have a computer background, so that also kind of helps me kind of parse some of this stuff a lot easier than, I think some of the practitioners in the space.
Do you think that your background in computer science has been a significant help in getting up to speed?
I think that the combination of, the finance background I have, as well as like the technological kind of aspects of it, definitely help. Because certainly, I think if you're trying to read a white paper for a certain protocol, for example, a lot of it kind of relies on multiple disciplines in order to kind of understand. So I think it's not easy for anyone, absolutely, but it helps to at least have some kind of background in this stuff so that I can kind of read it and I say, like, okay, that's a concept that's familiar to me, either from the financial side or economic side or from the computer science side. So that I can kind of put it all together and make sense of things.
Yeah, I can see how a combination of skill sets can really help in this industry. Let's jump into DeFi. So you wrote an interesting report on earning passive income. Most of the questions I have are going to relate to this report, but from a high level, can you tell us how things are looking in the current market?
Yeah, it's been pretty tough. I would say that overall, we've seen the activity on in terms of DeFi, and I'm looking at total value locked, for example, that's fallen from around $180 billion back in December 2021 to around $50 billion at the moment. And we know that some of that had a lot to do with some of the deleveraging events that we've gotten in the space, like Celsius is a big one. Unfortunately, we've seen that event kind of saw a lot of things kind of taken out. But also, it's not just things that are idiosyncratic to DeFi. I would say also what's been going on outside in traditional finance as well. Like a lot of central banks have been tightening rates in the US, for example, for at least the last year. And we've seen that relative yield in DeFi from just say like borrowing and lending have really kind of fallen behind a lot of those risk-free rates. So quite frankly, some of the hyper optimization in terms of people kind of seeking yield in the crypto space subsequently isn't quite there because the yields just aren't there as well. Also kind of note that, we've been in a crypto winter since at least the end of 2021, which means that for some of these platforms, for example, they were attracting users because there were liquidity incentives. Well, a lot of those liquidity incentives have been in depreciating territory. So, those also aren't quite as attractive for people who have previously kind of demanded that in order to be participants in the space. So I would say that, going back into like 2020, these were not major issues for DeFi the way it is today. Back then, global central banks were just cutting rates really aggressively. DeFi platforms were just like a really attractive alternative for market players who were kind of rotating away from fiat, especially if you were seeking that kind of yield. So I would say that the overall state of markets, it's not as if it's unhealthy. I would say it's just developing, because I'd say that this is now a precursor to maybe the next stage of DeFi. I think things are a little bit more complex, but also there are new things developing, liquid stake tokens, for example, which are kind of changing the way DeFi is done.
Yeah, I'm glad you brought up liquidity incentives. I want to get back to that, but what did you mean by active versus passive investing in DeFi?
Yeah, so when I'm talking about passive income in DeFi, I'm really kind of differentiating that from taking an active investment approach in the space. And by active investing, I mean like people who are buying tokens, trying to actively manage portfolio, using those tokens, for example. And the reason I make that distinction is because during periods of risk aversion, kind of like what we've gotten over the last year, I think a lot of investors are trying to think about how do they mitigate some of the directional risk that they faced. And that's, passive income from DeFi is just kind of one approach. We've seen that in trading strategies as well. Some people employ like trend following, where investors try to read market signals and kind of figure out where they should be taking a long position or a short position, or maybe just take a neutral stance. You have momentum strategies where people take like a relative value approach to assets. So I kind of characterize passive income in DeFi as a way to just get more of a consistent income stream when markets tend to be really volatile, because that way you kind of focus on rewards from like lending, liquidity pool, staking. And it's not to say that the performance of those things can't be impacted by markets. In fact, they are. But it's very different from, say, buying an altcoin only to see like a really bad economic GDP print or an aggressive central bank action hitting us and then hitting the tape and therefore impacting the price of that asset. It's very different when we're talking about passive versus an active approach like that.
Yeah, that makes sense. That's a really good distinction. So if we talk about DeFi in general, there are three major areas. There's staking, borrowing and lending, and providing liquidity. Essentially, could we ignore these differences and just say, when you put money or tokens into a pool, whether it's DeFi lending or DEX, you can earn something in return, whether that be more tokens or some form of APY or interest?
Well, I would say, first of all, it's definitely not the same. I also think we need to be careful when we use words like interest instead of rewards, for example. I think we definitely need to have some nuance on this kind of stuff, because, to first of all, like to various degrees, like there are certain types of economic risk that might be like at least similar or consistent across many of these different things. And I think that that's kind of like where I would kind of focus. But let's kind of start with like each of these parts. So let's kind of take like borrowing lending, because that's a good one. It's probably the simplest one, since hopefully everyone knows what borrowing and lending are. I mean, it's part of the traditional financial system. Maybe you've gone to the bank, you've borrowed something, you've collateralized an asset in order to borrow that money. It's just the foundation of finance. But I would say what makes borrowing lending unique to the crypto space is how it happened. Because effectively what we had was, say, like 300 million wallets, right? And people are in those wallets, people are sitting on assets, say Bitcoin or Ether or something that you believe in, you foundationally believe that there's value in these tokens, but you try going to a traditional bank, try going to JP Morgan Chase or something and try to get a loan for those assets. No one's going to give it to you. And, maybe today's a little bit different, but but back then when DeFi started getting off the ground, like, what did we have to do? Well, we created these borrowing lending markets ourselves. We decided to create peer-to-peer lending and borrowing because we couldn't go to the bank, but we needed liquidity, right? Like, I need to pay my rent. I need to go to buy groceries. I need cash. I need like available things. Maybe someday like people will be taking crypto like at your local grocery store, but it's not happening right now. So, well, what do we need to do? I needed to find a way to get that liquidity. And I think that's what kind of makes like borrowing lending in the crypto space very unique and gives it a lot of stickiness and a lot of kind of staying power. Now, what is the risks involved in that? Because, I would say that the same ones that we have in traditional finance kind of carry over into what's happening in the crypto space, like bad debt, counterparty risk, collateralization, how we should think about that. I mean, these risks are fairly well known, but, it's important because some of that is handled differently in the crypto space in terms of liquidations, for example, or automatic liquidations from smart contracts, which is kind of what MEV protocols capitalize on, for example, or the inefficiencies on them. But that's one. Liquidity pools, DEXs, they're also very unique to crypto. The oversimplified explanation I give for what these things are or how they work, it's basically a place where users can trade crypto assets directly with each other. And kind of to make that work, you need to have liquidity providers who will deposit their assets into a smart contract so that automated market makers can actually fulfill any of those trades. But the bigger thing for me on liquidity pools specifically is how do we think about impermanent loss? Because that's a pretty big consideration when we're talking about how people interact with those protocols. Now, impermanent loss, I think, is an important concept because how I tend to think about it is it's kind of like the economic concept of opportunity cost. Like if prices are moving higher at the time, what am I giving up to be part of a liquidity pool and earn rewards on that? Because with liquidity pools, you always end up with a different quantity of tokens than what you started with. And it can contribute to the losses sustained in a DeFi protocol. So this is something that I think is very specific to crypto and how LPs, how DEXs are kind of supported. Then staking. And I think this has been capturing a lot more market attention because, specifically to crypto, there's a big event coming up with Ethereum Shanghai Fork. Hopefully for some of your listeners, they know what that is, but it's, a lot of validators who have previously been unable to unstake the ETH that they have on the network for the last 2.5 years. They're finally going to be able to get their funds out. This one's going to be interesting because unlike peer-to-peer lending in solo staking, at the very least, you aren't giving up your tokens to a borrower, for example. Rather, you actually still retain custody of your assets and you earn rewards for providing security for that network.
Great. Yeah, that's a really good explanation. And there's certainly a lot of eyes on the Shanghai upgrade. But let's get back to using DeFi. When it comes to the tokens, whether it's borrowing or lending or providing liquidity, are there any additional benefits of using something like a stablecoin, either USDC or DAI, versus using a staked or a wrapped token like staked ETH, CBETH, or some other type of wrapped token?
Yeah, I wouldn't necessarily put like stable coins. Let's just say this. I wouldn't put all these assets in the same kind of basket. Like stable coins, for example, do a lot of heavy lifting in the crypto ecosystem. But right now, at least, when it comes to the APY on stable coins, at least for many pools and platforms, it doesn't quite have the same attraction as maybe 2 years ago when real rates were deeply negative. These days you can kind of open up a CD or like a certificate of deposit account, and you can earn like 4% for 6 months pretty easily. But you don't need to kind of do any additional work. For example, like if you're a novice in the crypto ecosystem, you'd have to kind of figure out how smart contracts work, make sure that it's secure, make sure that it's been audited. But staking, on the other hand, I think that's kind of where things are getting interesting. And here, I would kind of point out that there are at least two big benefits when it comes to staking, and maybe not just staking alone, but also like liquid staking. So I kind of described staking already, but for anyone who doesn't know, liquid staking is where users lock up their tokens to secure the network, but they do it through a third-party entity. So they stake the token, and in return, they get a receipt token, which is evidence of their ownership of their stake. And then they can then transfer, store, trade, like just utilize that receipt token in DeFi or other applications. And the first big benefit of that isn't necessarily financial, but basically you don't have to worry about unbonding or bonding periods. In the case of Ethereum, you don't have to worry about not knowing when your stake tokens are going to be unlocked. You can just basically trade your position and get out if you need to. The other big benefit, though, is more financial, and that's earning rewards on your staked asset. So you're getting rewards for securing the network, plus you're getting additional rewards for, say, lending those staked assets to a borrower, for example. So you're getting more earnings on top of what you're also making just for securing the network as a validator.
And on these liquid-derived tokens, are these essentially allowing users to trade or use an asset when they previously could not?
Yeah, you have to understand the unbonding periods are definitely variable across different platforms. So some of them are as short as a few days, some of them are as long as a month. So first of all, like using liquidity or liquid stake tokens actually allows you to kind of get in and get out and not necessarily have to worry about those unbonding kind of periods. So that's the first. But I think ETH is probably the biggest use case that we've seen, predominantly because for so long, we didn't know when our staked ETH could actually be withdrawn. Now we kind of have a better sense, right? Like it seems like the Shanghai fork will enable that probably coming up next month in March. But still, I think that has kind of increased the prevalence of liquid stake tokens because a lot of people like became familiar with them because they wanted to know, like at least have the knowledge that they can kind of get out, which you could do by going to the secondary markets. So I would say like that was kind of the big unlock. Maybe liquidity won't necessarily become the biggest factor in the second iteration of this, because once things get unlocked on Ethereum, for example, that might not be as big a consideration, but we will still probably be scrutinizing some of the elements of capital efficiency, tax efficiency, potential like slashing risks, things like that. And I think that means we're going to look at the quality of these liquid staking providers, as well as kind of some of the other beneficial offerings.
Yeah, that makes sense. There's definitely a lot of change happening. Going back to the report, you mentioned institutions and corporate funds are starting to use DeFi. Does this indicate a major shift in the way that traditional finance is viewing or using crypto? And how does this change in corporate investments affect the trends that we're seeing right now?
Yeah, I would say that, like, first of all, like for me, I think that the concepts of permission DeFi, for example, as well as tokenization, are really kind of like concepts that kind of work together when we're thinking about how corporates or institutions are thinking about DeFi or thinking about how it works in the space and their participation in the space. Some of that isn't new, like especially tokenization. I would say tokenization in terms of real world assets, securities, it's definitely something we've been talking about since like back in 2017. To which a lot of people kind of question, like, well, why now? Why is this a time where we need to be worried about it? Why are we thinking about it? Like, what's the actual durable use case for this kind of stuff? But then you kind of look at the headlines, and that is super promising in terms of what we're getting. Like, just look at what happened recently. You saw that Siemens just announced, like, they're an industrial manufacturing conglomerate. They just announced that they're issuing a 1-year, $65 million bond on the Polygon blockchain. They're talking about how this is going to reduce operational overhead, which, you tend to see with bond issuance trading. We saw that there's a DeFi protocol, Clearpool. They actually announced that there's going to be an institutional credit platform that they're calling Clearpool Prime. And then, like even over the last couple of months, SocGen issued OFH tokens based on like French bonds or French home loans, which, they could use as collateral to borrow DAI. There was Project Guardian with the Monetary Authority of Singapore, which allow like JP Morgan to kind of transact with DBS and SBI Digital Holdings in order to kind of trade like tokenized Sing dollars with tokenized yen on bonds using like an institutional like DeFi platform like Aave. So I mean, all this stuff is just signaling that there's a lot of growing interest from institutional pools of capital. They really want to experiment with capabilities of these decentralized protocols. But more than that, I think kind of what people are missing, and not just outside of crypto, but even inside of crypto space, is that a lot of the ways these things are interacting with each other is very different than where it was previously, because each of these entities is kind of building out their own separate element of the infrastructure needed to actually have a institutional or permission DeFi kind of structure. So for example, like something that we couldn't do without blockchain technology is intraday repo. Like now people are really looking at, hey, what are we going to do with intraday repo markets? How are we going to use blockchain technology to enable that? Like someone's building that. And like each of these building blocks are going to be put together so that there's actually going to be a full-on marketplace that can actually do this kind of stuff. And that is the big unlock. That's what's different about now compared to 2017.
Yeah, really exciting. So with all of these funds moving into some form of crypto, are there any downsides to more money flowing into DeFi?
I don't know if I would say it's necessarily about more money flowing in DeFi and whether there are like upsides or downsides to that. I mean, like liquidity is the lifeblood of any financial system, you know, and I think we need to have a responsible approach to that. Because if we're thinking about, say, like lending, you know, we kind of have to think like, what are the underwriting standards in the space? Like, what should we abide by? How do we think about collateralization? What about asset liability management, for example? So it's not really that simple as saying like, hey, more money flowing in the system. That's great. Like, you know, like, is it better because we can do more stuff? Yes, you know, but like the way I kind of think about it is if I was like a fund manager, and someone was saying like, you know what, you're doing a great job. Here's more money I want you to manage. Like, you know, please take it and do something with it. It sounds great, right? Because yeah, like if I have more money, like it gives me more options rather than fewer options. But let's say I'm running a really specific trading strategy and the universe of assets are fairly unique to that one strategy. They're actually finite when it comes to that particular strategy I'm running. I have the other problem, which is where do I put that money? Because like I can only put it in so many places. It gets complicated as well. So it's not just saying that like, hey, more money flowing in the system is a great thing or a bad thing. It's about how we utilize these things and doing it in a proper, smart way.
Great. Yeah, that's a great answer. Let's switch gears a bit here. When it comes to the research side, what quantitative steps would you take to evaluate a new protocol or a pool?
So I tend to look at a mixed set of like technical and fundamental factors. So let's say I'm looking at a protocol specifically, like a layer one protocol. You know, I tend to like looking at the underlying tokenomics of that. But I'm also very cautious about how I use certain metrics. You know, like for example, let's just kind of take like inflation. I think that's a good one because many of us kind of look at that and say like, hey, supply is growing. Like, you know, what's this doing in terms of diluting my value? You know, for those of us who kind of subscribe to the Austrian School of Economics, and I'm not saying I'm one of them, but, you know, like the way it's thought of is inflation tends to be driven by an increase in money supply. So money supply is often seen as one of those key aspects to follow for valuation. And you hear that when people make bullish arguments about, say, like ETH, right? Like when Ether is strengthening and people are kind of saying like, well, you know, more ETH is getting burned than minted right now. It's deflationary. This is a good thing. And, you know, is ETH being deflationary important? Yes, absolutely. I'm not saying it's not. But we have to remember why we care about that, because like any protocol can actually set themselves up to, yes, programmatically be deflationary. But what we care about is what's the organic growth on a network, what does development kind of look like? And we care about that because this sends a message about, well, if an asset is deflationary, so if its supply is deflationary, what does this say about the cost of securing that network? So assuming the security is high, transaction activity is rising, and the supply of the token is limited or it's falling, only when you take it together does it actually offer you a very good value proposition for that token. It doesn't mean anything just by itself.
Mm-hmm. Yeah, I'm glad you brought up that point about activity. How do we measure activity, whether it's in a protocol or a pool or a network?
Yeah, so one of the key ways that people kind of look at activity is through like total value locked. And it's not necessarily a bad measure per se. I think that it's a very useful one in many ways. It's hard to actually find alternative metrics to TVL, in fact. But, you know, I think that a good way to think about it is like this. So let's say I'm trying to think about like relative value in the crypto ecosystem or in the asset class. And I'm looking at, say, the difference between TVL as a stand-in for activity and price movement. So pretty simple framework, right? Like the way I might think about it is I might see, hey, where have prices been going over the last 3 months? Let me compare that to how TVL has maybe been rising or falling over that same period of time. And I might, venture to say, listen, if the total value locked is rising, but prices are falling, well, maybe that means that this particular token might be undervalued and might look like a buying opportunity. But think about that, because maybe you'll already see what the problem is, or what the problem is. I'm going to say, because number one, there are any number of factors that could have contributed rather to an increase in TVL on a certain platform, and that could have nothing to do with any organic demand for that platform. For example, like it could be completely artificial. Like let's say that protocol started having an offering that said that like we're going to airdrop a certain number of tokens if you participate on a platform. So it might suck out like some of the activity on a competing platform and bring activity there. But like, is it happening? Yes. But is it organic? I wouldn't necessarily think say it is. Moreover, I think that some people mistakenly kind of look at TVL and they believe that it implies a certain level of security for a protocol, which I also don't think is true. For me, what's as important as like just the overall TVL number is like, what is the composition of that total value locked? Because, does a particular chain have more stable coins than another chain, for example? Or is that total value lock sitting mostly in illiquid FTT tokens? I don't know. But only then can you actually have a more fair comparison of like, what does activity on one network in TVL terms look like compared to another network? And I think the problem is that for a lot of people, that just takes a lot of work, right? Because many people would just prefer to look at two numbers and say, well, 100 is, bigger than 50, so 100 is clearly better. But that doesn't have to be true. Like I had a professor in college who used to tell a joke about how, someone lost their keys and they dropped their keys and they dropped the keys near the front door. They can't find them. A friend kind of comes by. They sees this person looking for the keys, but that person is looking in the kitchen. So the friend asks, but wait a minute, I thought you lost your keys near the front door. And the person goes, yeah, but the light's better here. And I think that's kind of a consistent problem we have in research, that people look where the light's better, but they're not looking where they should be.
Yeah, that makes sense. And another part of TVL that I find really misleading is the association with prices and exchange rates. For example, when the exchange rate of the underlying tokens moves up, you'll have an inflated TVL number, as TVL will also move up. Even though there's been no change in the pool, no more funds moving in, no more liquidity, it's just the exchange rate.
Right. It's often measured in dollar terms, and you really need to be seeing it in native token terms. And it's hard because then you can't compare, because I need to compare apples to apples, which is why we use dollar terms, but that's not a fair comparison because you include price appreciation in that.
Is there a safety and numbers effect happening with liquidity into a pool? So for example, if I have one pool with 10 addresses providing liquidity versus another pool with 1,000 addresses providing liquidity, maybe 1,000 addresses or even 1 million addresses sounds a lot safer.
I like to think about it in terms of ratios. So it is important. But for example, I would say it's more meaningful to me to not just look at, say, the number of active addresses on the network. It is important from a Metcalfe's law kind of perspective in terms of greater adoption and kind of using that as a sense of activity. But like, I would also want to know like how many transactions are those people doing, or what's the size of those transactions those people are doing, for example. Like if I could see the number of transactions relative to the number of active addresses, that's meaningful to me. Then I'm actually attempting to assess the network, not just through those numbers of active wallets, but also by how much activity those wallets generate. And I think that for me is kind of what I'm kind of pointing to. You can't just kind of look at any one metric in isolation, but rather you kind of have to look at these things in combination to understand what the real activity is or how things are actually growing.
Yeah, that makes a lot of sense. Let's go back to the topic of incentives. How do incentives play a role in DeFi generally? Is it a zero-sum game all the time where one pool provides an incentive for LPs versus another pool where users already exist? Are they always going to move to that higher yield pool or the higher incentivized pool? Do these incentives play a role in DeFi?
So I think they do. They have historically kind of played a role here, but fairly or unfairly, the way people kind of tend to think about these things is that it's a winner take all market. And, I don't necessarily believe that's true. I do think that, liquidity as a result, it tends to be the primary focus people have, which is kind of why, for example, stablecoins have become such a hot topic, or, why you see so many launches for stablecoins, because they know that that's one way to get liquidity into a platform. And the more liquidity you have, the more people are transacting on it. The more like you kind of build up the strength of your platform. So it is true, you need it. It will kind of support things, and you require like a platform to have liquidity, because otherwise, how are other people going to trade on it? Like, how are you going to grow and build yourself? But also, I think that it's kind of disingenuous to kind of use an airdrop or something of that nature just to kind of try to attract activity one way or another. And we've kind of seen that, right? Like there are things in the crypto ecosystem where people have been influenced by those kinds of decisions, and it hasn't always worked out in the end. So you just kind of got to be careful if that's the primary motivation behind moving to a certain DeFi platform.
Well, David, thanks a lot for your time. I thought it was extremely insightful and really great to hear your perspective on the current state of DeFi and where everything's going. Again, really grateful for your time, and it was a pleasure talking with you.
Thank you. This is great. It's my pleasure.